Hi guys, Welcome to, I hope you can all see my screen. This is the screen that I'll be using to present to you today, the Multifamily Investing Made Easy. Using syndication to create long-term wealth and help scale your real estate business with me, RE Syndication. So we're gonna have a great day today, a great afternoon. It's 4:33. Hope some people will be joining us in a little bit. This will be going up on YouTube, and I will be sending out a live link once the recording is over. But without further ado, let's just get cracking and straight into today's webinar. And as I said, this will be recorded. It will go up on YouTube, and I'll send out the link. So please don't worry if you have joined late. So let me get my PowerPoint up and running. And I need to be pressing slideshow. Okay, so today's guide is about, sorry about that. So today is all about understanding how to use syndication to create long-term wealth. I'm your host, Reed Goosens. Thanks for dropping by. If you are watching this and it wasn't live, it's fine. This link, as I said, will go up online at youtube.com under RSN Property Group, I think it is, or Reed Goosens. You can search either or of my names, and a link. I will pull a link, send out a link on the Facebook page, and the Facebook page is LA Real Estate and Crowdfunding Club. It will also go up on the Facebook page for RSM Property Group. So you can literally search RSM Property Group and it'll be a free link on there as well. But let's get started and straight into what we're going to be covering today. So on today's webinar, we're going to be covering, as I said, all the syndication basics. We're going to go into understanding really what is syndication. A lot of people have heard about the name syndication. They're not 100% sure how it works and what it is. And how it can help you as a tool to grow your real estate business. We're going to look at why do people engage in real estate syndication, understanding the different mindsets behind the people involved. We're going to look at who is involved in a syndication deal and cover sort of the main players in a syndication deal. We'll understand the syndication process, which is very, very important, because if you don't understand the process, you won't be able to then go out and find cracking deals, and then what comes first, the cracking deals or finding investors. I'm going to talk a little bit about how you make money using syndication, and we're going to talk about, obviously, the structure is very, very important. I get a lot of questions about how to structure a syndication, and they can vary from deal to deal. But we'll go into what I've seen people structuring and how I structure my syndication deals. We'll talk a little bit about the risks of syndication, and we'll go into some of the 4 biggest mistakes that I've seen people make using syndication in their real estate business and what I've been taught over the last 4 years. Finally, we're going to go into how do you raise money from investors, because that's a really big topic. And literally all of these subheadings we could talk about in an individual show, but we're just going to cover these today, and we're going to go from a sort of a big macro high level point of view, and over subsequent webinars I'm going to knuckle down into each and every one of them, the processes, the risks, how to mitigate risks, and we'll go into more details as the months and weeks go on. So please keep an eye out for that on Meetup. We'll also quickly look at my sample deal, my first real estate syndication that I did last year in 2015 with a couple of my partners. So let's get cracking. So who am I? Some of you might not know who I am, and that's fine. I completely understand that. Not many people know who Reed Goosens is, and I don't have that big of a presence online, but I'm trying to slowly build a presence. So that's a picture of me. That's what I look like. If you don't know what I look like, Reed Goosens. My background. So I'm the founder of RSM Property Group. That is my company, first and foremost. My background is in structural engineering. I studied structural engineering at the University of Queensland in Australia. And if you haven't figured out by now, I'm not American. I am Australian. And I was practicing structural engineering for 9 years. I graduated in 2007 and did a whole bunch of stuff, and recently just quit and went into real estate investing full time. I've lived in the United States for 4 years. I've lived in New York City for 2 of those years, and now in Los Angeles in some warmer weather. And I moved out here for love because my girlfriend is American. I've been in, as I said, been in real estate syndicate, real estate development and construction for 8 years as a professional. So as a structural engineer, I was surrounded by real estate development and construction, not knowing the investing side for the first 4 or 5 years of my professional career. And for the last 5 years, I've been an investor, or starting out being an investor. When I first picked up Rich Dad Poor Dad back in 2010, back in Australia. That's when I first picked it up and first started that, got the bug to invest in real estate. I've developed my own cash flowing portfolio here in the United States of duplexes and triplexes, and now moving into sort of larger scale syndication. And the real point of, and I should sort of elaborate a little bit more on this, the reason I'm putting this presentation on is to show you that you can still do all of this sort of stuff. And I was doing all of this, and I syndicated my first deal whilst I was working full time. So it can still be done. You just have to, you got to want to push yourself to that next level. And I completed my first major syndication in 2015. These are some of the pictures of the one on the left there is of Paddington Station, the iconic Paddington Station in London, United Kingdom. And I was involved with the redevelopment of that particular, the redevelopment of the Paddington Station for the 2012 Olympic Games. Now, this is back in 2009, 2010. And the reason that they redeveloped this sort of station was because people would jump off the airplane at Heathrow Airport, and the first station they're going to see when they pop up from the underground is the Paddington Station. So that is the Paddington Station. And then on the right-hand side is the Macy's in downtown LA. That is the revamping of the Macy's Center, and I was working on that up until halfway through early 2015 as a structural engineer. That's a bit about my background. These are a couple of the houses that I own up in upstate New York that I've got a small portfolio, as I said, a couple of duplexes and a couple of triplexes. That's what I cut my teeth on. I flipped a few properties in Philly. This just happens to be one of them. This is going back probably 6 months ago, but we added it was a sort of little row house. It looks a lot better than that. We sold it for a lot. It looks a lot prettier when we sold it. But what we did was added a third story to that with a rooftop deck. And this is the large first syndication, 250 units in Houston, Texas, which I did last year with a couple of my partners. And obviously, RSM Property Group is the company that I have started now. So let's get into why we're all here, and we're learning about real estate syndication and what it is. So, what is real estate syndication? Well, simply put, I'm going to try and break it down as much as I can today. I really want to try and get into the nuts and bolts of making sure everyone understands what I'm talking about, because real estate syndication isn't just something that you just happen to stumble upon. Most people go into real estate syndication because they run out of money and they need to, they can't just buy all their own deals, and they need to use other people's money to help buy larger deals. So number one, simply put, real estate syndication is a type of financing for your real estate deal or business. So if you think about businesses, for example, just a business, any business, you need money to operate, and that is why that syndication is an ultimate opportunity to finance a business. It's a way that businesses need money to help grow. So they look to investors to rent their money out, and you'll say, and in our case, our business happens to be real estate, real estate investing. So you to grow as a business, you need money, right? That's how it happens. You look at any sort of big business across the world, Google, Facebook, Yahoo, any BMW, name any business, they didn't get to where they are today by using the founders using their own money. They got to where they are today by using syndication as a type of financing to help get their business to the next level. So it's businesses looking for financing through private equity. That's really what it is. That sort of simply put is one of them. This was the first reason, I should say. The second reason is that it offers money a place to invest. So think about that for a second, that you have on one hand, you have businesses that are needing money to operate. And on the other hand, it offers money. So there's a lot of money out in the market that is looking for a good place to put their money to make a good return on their investment. So it's a financing for your business on the business side. And if you're on the investing side, it offers money a place to invest. Now, syndication, as I said, is just the word and the platform that you use to bring those two together. So by bringing those two together, in our case, we have the investors, and we have in our case, our business is the real estate. And in my case, it happens to be multifamily. We syndicate on large multifamily deals. So it's the capital from the investors who are looking to rent their money out, funding the deals, which is which funding our business, which is the real estate deals. And what we do is we form a partnership. So it is investors who want to rent their money out, and they look for places to put their money, and they will look for businesses like our business, which is real estate investing or a real estate deal, and you'll then come together and form a partnership, and you'll both make money together. So I hope that is simplified the overall understanding of what real estate syndication is, and in layman's terms, to cut it down even further, it's the act of pooling money together. So you might have, say, 5 investors; they all have $100,000, and you have your business is real estate, and those 5 investors come to you, or you go to them and say, "Hey, I need money to help fund this deal that I'm trying to get together." Well, that is exactly what it is. You pull that money together. You put in some money, they put in some money, and then you go out and buy this larger deal, because by your own, you wouldn't be able to take down that particular deal by yourself. So you needed a few other investors involved to take down that larger deal, and you're able to go out and find larger deals because you have a lot more money or a lot more capital to place in a real estate deal, in a multifamily deal, or in your business, which is real estate investing. So why do people engage in real estate syndication? Well, the main reason is that syndication is the ultimate leverage opportunity. Really, I want to drive this home. Write it down. Whatever you've got a pen and pad there. And by the way, this will be available online, and I'll also be able to give you guys the slideshow of this, because it's you can have it for free. It's easy. But sorry about that. I went off track there. But syndication is the ultimate leverage opportunity. So and the reason it's the ultimate leverage opportunity is because I, as a syndicator, can leverage other people's money. They might be too busy. They're in a day job. They don't have the time and energy to go out and find cracking real estate deals. I, as a syndicator, or in my business, I can find those cracking deals, and I can then offer those investors who don't have the time or the energy to find cracking deals, but they still know the benefits of owning real estate. They still want to have real estate in their portfolio. So they then leverage me to find those cracking deals because they're too busy. So it's the ultimate leverage opportunity, and it's a win-win for both parties. It's a win for myself, which is the real estate business owner, and it's a win for the investors, because they don't have to spend all the time and energy going out and finding a cracking deal. They can just give the money and they get a great return on their investment. So it's better than sitting in a bank and earning 1-2%, if that. So syndication is really the ultimate leverage opportunity to help grow your business. The more investors you have, the more deals you can get done, and the larger your net worth becomes, and you create long-term wealth together. So I hope that really driving that home. So who is involved in a syndication deal? Well, the first person is the syndicator. You might have just heard me say it. It's a syndicator, which is the sponsor. I'm the syndicator. RE Syndication, or RSM Property Group, is a syndicator. And what is that? As I just said, it's an individual or it's a company. And as you're starting out, you're going to be an individual, right? You're not going to be and I'm still an individual. I just have a face called RSM Property Group, but I still go out and people invest in me, Reed Goosens, because they like me. They like my professionalism. We'll get into that a little bit later on in the show, but it's an individual or company. And typically they will find and they will manage the deal. If you're listening to this and you want to become a syndicator, just understand you are going to be doing the A to Z of finding cracking deals You're going to do everything. You're going to have you're going to be doing everything from A to Z in terms of acquisition to overseeing the operation of a deal, particularly in multifamily investing. So this individual or the syndicator, they typically need to have a history of real estate investing experience. So that's what I said before. Typically, I cut my teeth on some flips in Philadelphia and some cash flowing properties in upstate New York. I got to the point where I had run out of money, but I still wanted to continue buying these large deals, and I was still finding really, really good deals. So I then transitioned my business into being more of a syndication business, and that is what I now purely focus on. I pool investors' money together to go out and help buy. We can take down larger deals together. So you typically have a history of real estate, and you might be out there saying, "Oh, well, I've not done a deal yet," but that doesn't necessarily mean you can't use syndication. It just means that you need to understand the real estate investing process. So I'm going back and forth, but a syndicator will underwrite the deal. You'll carry out all the due diligence on the property. You're going to oversee the entire negotiations between the seller and the broker. The syndicator will create the legal paperwork to form that partnership we just talked about with the investors. You're going to perform as a syndicator the asset management. So you're going to oversee the cash flow. You're going to oversee the type of rehabilitation that the property goes through, and just really the day-to-day management of the property. You're probably going to employ a property manager, but you're going to wear a lot of hats. You're going to be an asset manager. You're going to be a project manager. You're going to be the owner, and you're going to also be an investor liaison. So that is really what a syndicator is, and that's what I said. A syndicator is the sponsor and oversees the A to Z from finding the property to acquiring the property and overseeing the operation. The second person obviously involved in the syndication deal is the investor. And the investors are individuals who want to invest their own capital into a deal. And as I sort of said before, these guys are people who know the benefits of real estate, but they might not have their finger on the pulse. They might be in IT. They might be in Hollywood. Or whatever. They might be in just another profession, not real estate, but they want to have the benefits of real estate, which are the depreciation. You want to have forced depreciation. You want to have appreciation. You want to have amortization, and you want to have depreciation in terms of tax benefits. They want to have all those things and more, but they just don't have the time and energy to go out and find those cracking deals, and that's where you as the syndicator come in. So the investors will own a percentage of the property or the deal based on the capital that they invest into the deal. And as I just said, they have the benefits of owning real estate, but then they're also hands off. So they're not going to be getting into the weeds of understanding what renovations you need to do on the property. They're not going to get into that. They're not going to get into the negotiations with the seller. They're not going to get into talking to the property manager. They're purely hands off, and they're just going to sit back, get the benefits of owning real estate plus a return on their money. And we'll talk about that in a little bit in terms of how you structure that deal and what the investors' returns are. And as it says there, they're going to look for a return on their investment, because that's why they're coming to you, because you have the cracking deals. A third person that can sometimes get involved with a syndication is called an equity partner. And an equity partner, it can be someone, it's a loose term, but it's someone that can link you with a bunch of investors. So it might not, you'll pay them a couple of points, or they will cost you to do that. But there's what's called equity firms out there that have access to a lot of good investors, and they will link you with those investors, but for a fee. So they come in, they can be involved in any stage of the deal, but you've got to have a bit of track record before you go to these types of guys. You can't just go to them straight away and they will expect to give you their investors. So they're the sort of three people involved, or three major players involved: the syndicator, the investor, and the equity partner. And as I said, it connects, and so these are the syndicator, investor, and it connects to the investors. The syndicator connects the investors to the real estate deal. So the power of syndication, and I've alluded to it just a little bit before, is using other people's money, or OPM. Now, if you're listening to this and you are wanting to become a syndicator, this is the power of syndication. It gives you access to greater deals. using other people's money to build long-term wealth. And I let the cat out of the bag a little bit earlier on, but the speech before about businesses, about Google, about Facebook, about any business you want to think of. They didn't get to where they are today by just the founders using their own money. They used other people's money. And I'm really going to drive this home. They use other people's money as leverage to grow their business. And they were able to grow the business into a point where it's a cash flowing business or whatever that business might be, to build long-term wealth. In our case, we as syndicators are using other people's money to buy real estate deals. Now, in my case, I'm buying large multifamily deals. You can be buying, you might even do a small syndication on a house flip. It depends. It doesn't, maybe not as so much, but typically on the larger the deal, it means that I don't have the resources personally to go out and buy that $10 million deal or that $5 million deal. So I've got to go out and find investors who want to partner with me, and we form that partnership. They want to rent me their money, and I can use their money as a down payment. We get conventional financing, and we're able to build long-term wealth. So the power of syndication is OPM, other people's money. So what is the syndication process? Well, the syndication process starts out with the syndicator, which is, me, you, people out there who are listening, who want to be a syndicator. They find a cracking deal. They say, boom, I've got my finger on the pulse. I'm sending out my yellow letters. I've talked to someone who's got a cracking property they want to get rid of at dirt cheap prices. And they find the real estate deal. And so that's why you are the syndicator, because you have access for whatever that might be through your networks to find really good deals. So once you've found that really good deal, you might put it under contract, and we'll talk about that in a little bit. A syndicator is going to create the syndication, and the syndication is you're going to create the legal paperwork or the framework which is the syndicated partnership, which is the entity. You're going to create essentially an LLC, and that LLC will effectively buy the real estate deal. So the syndicator has found the deal, he's put under contract. You then gone out and created the legal paperwork to form the syndication. So then you've got to go raise the money from your investors. So you're going to go raise your money from the investors, and you might have already talked to the investors prior to finding this deal, and you've got them all hyped up and really engaged in what you're trying to do. And they're going to say, yeah, hey Reed, or hey whoever, I love this deal. This is exactly what I wanted. I'm going to get a cracking return on my investment. Here's my money. They're not going to give you the money per se. They're going to give the partnership, the LLC that you've formed between the investors, yourself, and that partnership they're going to fund. And by funding that partnership, they fund the partnership, which is just that we can then go and buy the deal. We can close on the real estate deal. So that's the sort of syndication process in a nutshell. You find the deal, you create the syndication paperwork, you raise the capital. Those investors then fund the partnership, and then that partnership or that entity will buy that particular deal. So how do you make money using syndication? Well, as the syndicator, you're going to get deals. You're going to offer services, and you're going to offer the deal. So for the investors who want to invest with you, you're offering a service of providing them a cracking deal, right? There's that cracking deal, and you're going to offer the service of I'm going to deal with everything. You guys just sit back and relax. So for that, typically you're going to have what's called a syndication fee, and that's an upfront fee that you will get. Typically 1.5% to 2%. That's a fee that you get for pulling the deal together and for doing all the hard work. And that's common. It's a common fee that you'll see, 1.5% to 2%, and that's of the total purchase price. If it's $1 million, you're going to get 20 grand. If it's $10 million, you're going to get $200,000. That's what it is. So you're also going to, because we'll talk about structuring in a little bit, but you're going to get cash flow as a syndicator, because you're going to own a portion of the deal. That's the whole point. You're creating long-term wealth here. You're going to have equity in the deal. So you're going to get cash flow. You're going to get profits, because we talk about, you're going to get the appreciation of the deal when you sell it in 5 years' time. And we're going to, on this particular show, this webinar, we're not going to get into how you get those profits or force the appreciation. That's another webinar down the track. But just remember, when you come to sell the property, you want to force that appreciation in the deal, and you want to be selling the deal at a higher rate, so you're going to have profits. So syndicator will share in those profits because you own part of the deal. So investors, they provide the capital for the down payment. That's what they do, and they're going to receive cash flow from day one. They're going to also receive profits because they own equity in the deal. So you as a syndicator will get fees upon closing for pulling it together. You'll get the cash flow and you'll get the profits. So will the investors, cash flow and profits. Because as we remember what we said before, it's a partnership between people with money and people with deals. And I'm the person, as a syndicator, I'm the person with the deals. You're looking for investor, or as an investor, you're the person with the money. So how do we structure a real estate syndication deal? Well, in my experience, and this is very limited, and as I said, I've only done one major one, but this is my experience and what I've been taught as well through my mentors and stuff, is that obviously the syndicator and the investor, we will form the syndication partnership, which is the LLC. It's the entity that we will own. I will create as a syndicator, and so I will own a portion of that entity, and investors will own a portion of that entity. And that entity will go and buy the deal, right? Will buy the real estate deal. And the typical equity split is about between 20 and 30% to the syndicator, and between 70 and 80% to the investor. Now, in this particular slide here is that the syndicator will be what's called a general partner. And that general partner, general partner, GP, it's called, and the investors will be called a limited partner. And you might be looking at that pie and thinking, oh, well, the investors own a lot more equity than I do. Well, the way you structure that partnership and the way you set up that entity is that the investors, as a limited partner, they can't take over the deal and seize the deal and say, they can't take control of the deal. The GP, the general partners, which is the 20 to 30%, depending on how you structure it, has full control of the deal and of the entity, and that's your role as a syndicator, and that the role of the investor is to invest with you because you have cracking deals, and you need to control that deal. You need to control the property management. You need to control the negotiations with the seller. You need to control how you reposition the deal. So keep that in mind, that there's a GP, which is the syndicators and the partners, and then there's the LP, which is the investors, limited partnership. So for the investors renting the money to the partnership, you're going to be paying them a preferred return, which is paid out in quarterly payments, typically between 5 to 8% based on the deal. And what the preferred return is when you buy a cash flowing property, when you buy a multifamily property, you're going to have there's equity in that deal, right? Ignoring the equity, for example, the deal's still going to be out of cash flow, and that produces positive cash flow. And that cash flow I can then pay that whatever I've agreed to, 8%, 6%, 7%, whatever that is. I know that the deal can pay. So say I raised $100,000 and my preferred return is 10%, right? I'm going to do simple math to the investors. So from investors, I've raised $100,000. The first $10,000 of cash flow goes straight to the investors. That's their pay, saying, thank you for, giving me your money to buy this deal. The next 2% or whatever that might be will go to this syndicator because we own, we own part of the deal as well. And then anything over that, if it's more than, if your cash flow is more than that, will be split based on the equity in the deal. So particularly we split 70-30. And then, obviously the investors have an equity. So we'll have an equity in the deal. And the equity in the deal is meaning that the money is still backed by real estate. So the deal's cash flowing, and I'm paying 8%, let's say 8% on what the investors have put into the deal. But then through certain way, what's called repositioning, I can force the equity, or force the appreciation and increase the equity in the property. And as I said, I'm going to get into that. That's a different topic to get into, but this is, from a high level point of view, these are the types of ways that the investor gets paid. They get a preferred return, which means that they get paid first before the general partners or the syndicator. And typically with a preferred return, it's not a guaranteed return. It just means that you get paid first, and then the syndicator gets paid. And the way I set up my deals is that if, say, I agree to 8% and my cash flow for some reason isn't 8% in the first year, maybe because we're trying to reposition the property, we're trying to do some work to it, and the vacancies are a little higher and we don't hit 8%. Whatever I don't hit, say it's hit 7%, then the following year I'm going to tack on that extra 1%, and that next year too will be 9% preferred return to the investors, if that makes sense. So that's the way that I make sure that my deals are run effectively. So, excuse me, what are the risks of investing in a syndication? And I'm going to just say, from a big point of view, this is not legal advice. This is just general what I've seen. Please consult your lawyers if you're getting involved in a syndication, both on the syndicator side and in the investor side. But they're the same sort of associated risks as owning any real estate investment, and that is, you can have variable economic trends. So, the world, you might have the economy might take a bit of a hit or whatever. So that you got to how do you mitigate against those? And I'll get into that a little bit later on. So you're going to have variable economic trends. There's a potential that you fail as a syndicator to manage the property effectively, reducing the income of the property, because say you let the property go, you let the property deteriorate, and renters don't want to rent there anymore, and you don't get market rent, so your income is reduced. So that's what you got. That's a risk. Unforeseen circumstances such as natural causes, like earthquakes, tornadoes, stuff like that. Renovations running over budget, failure to make debt repayments on your debt. That goes back to your income. Interest rates rising, limiting your cash flow. These are, unable to sell the property at the end of the hold period, etc. There's a lot of risks associated with, and this is not just from syndication. This is just in real estate in general. This is what real estate in general. As a syndicator, you need to be making sure that you mitigate these risks. And how do you mitigate? Well, let's go through the list again. How do you mitigate against economic trends? Well, you've got to be buying a good deal. You've got to be buying, making sure that you're buying in the right market, and you're buying below market value, because you want to be buying a cracking deal. And in terms of mistakes, in a little bit, I'll get into some of the mistakes, but you have to buy a cracking deal. Failure to manage the property effectively. Well, you are the syndicator. That responsibility rests solely on your shoulders as the syndicator. You need to be managing your property manager effectively. And that means you need to be getting a good property manager, not just anyone. You need to be getting the best of the best, because you're using other people's money to buy this deal. So you need to be treating their money better than you treat your money. Unforeseen circumstances such as natural causes. You have insurance for that. That's I sometimes get asked that question is, what about a tornado? Well, the roof gets ripped off. Well, I've got insurance for that. Renovations running over budget. So if you're buying a property and you've got to reposition it, you're going to put some love into it, replace the carpets, upgrade the units, increase the rents. Well, again, you've got to go back to your syndicator. You're managing that process, and you need to make sure that you're getting 3 bids from your GCs, your general contractors, and you're setting schedules, and you're setting making sure that the property manager is running that effectively, and you're running the property manager. So you can't just let that go. Oh, the property manager is going to deal with it. No, you have to be on top of that as a syndicator. Failure to make repayments on the debt. Well, again, this goes back to making sure that you purchase right, and you're cash flowing, because you don't want to have a negatively geared property. That's just not the point of it. You don't want to be hemorrhaging money. You want to be cash flowing. That's why I buy real estate. That's why I buy real estate, is for cash flow, and then I want to be able to force the appreciation at the same time. Interest rates increasing, limiting cash flow. Well, when you get the debt on the property, you want to be consider fixed interest rate. That's a way to mitigate that risk. Unable to sell the property at the end of the hold period. Well, that's you as a syndicator keeping your eye on what's happening in the market. As markets rise and fall, they will do that all the time, and you might have to either sell the property. You might hold on to the property a little bit longer because multifamily properties are a great little way to mitigate against market fluctuations, because people always need a place to live, and as the markets tend to drop, renting increases, and that's only going to help multifamily investments, which is what I do. So anyway, there's sort of the couple of the risks involved in syndications, and just remember, like anything, they're the same risks in any real estate deal, whether it be a fix and flip or a multifamily. It's the same. These are the same sort of risks involved. And at the end of the day, if you're a syndicator or an investor, you have to do your due diligence. Whether you're doing, as a syndicator, the due diligence on the property, or the property manager, or the on the general contractor who's doing work, you have to do your due diligence. If you're an investor, you have to do your due diligence on the syndicator and ask those hard questions of, who is your GC? How many? What sort of work does he do? Who's your property manager? How many properties are they managing? Ask all these questions. The more questions you ask, the better. So just do your due diligence. What are the 4 biggest mistakes I see syndicators making? And these are just some of the typical ones that I've seen. By no means am I any crazy expert on this. I'm just giving you some of my advice that I've seen. First one, number one, hands down deal is buying a mediocre deal. You're buying a crappy deal, essentially. You can't buy a crap deal. You have to buy a great deal. And people get involved in real estate, in multifamily space, and they might have a couple of friends that pull some money together, and they just go out. They're sort of they're gung-ho, they're too gung-ho, and they pull the trigger on a deal that's maybe not as good of a deal as they think it is. So you have to buy a great deal. Another reason that you can't just buy a mediocre deal, because if you can't get excited by the deal, you're not going to get your investors excited about the deal. So keep that in mind. If you're not going, this is a cracker, then investors are not going to be able to see that, and they're going to have questions and concerns, and you won't be able to sell that deal to them as a great investment opportunity. Biggest number one thing is that you make money when you buy and not when you sell. So make sure you keep that in mind. Regardless of whatever real estate investing you do, you make money when you buy, and that means you're buying correctly. You're buying under market value. You're buying, in our case, a slightly distressed property, and it has room to move and to force that appreciation. You want to be buying a cracking deal. Mistake number 2, buying a deal that is too big. I've seen that happen a few times. And the bigger the deal usually means the more money you need to raise. And so you need to be confident in terms of how much money you can raise. Maybe going out and in my case, we did a very big deal, but I brought in other people to help raise some money on that. But maybe on your first deal, you might shoot for half a million bucks or $1 million. And so it means you can raise 25% of that. Can you raise $250,000 from friends and family and investors that you know? If the question's yes, then you know that is a good sized deal that you can take down. The other big thing is that, if your deal's too big and you can't close on it because you can't get enough investors, nothing's going to happen until people are not going to take you seriously until you get your first deal done. So cutting your teeth on some smaller deals, like even if it's only a 10-unit property, who cares? If you syndicated it, you got 2 or 3 mates together and you did it, fantastic. You got your first deal done. And you can't get to deal 15 without doing deal 1. Mistake number 3 is the lack of time to raise the money. And we'll go into a little bit of this, of the science of raising capital in a little bit. But what I mean by this is that you haven't told enough people about what you're doing prior to looking at deals. I've always thought of real estate syndication as sort of turning 2 wheels. One wheel is that you're trying to find investors. You're always trying to advertise yourself or what you're trying to do to friends and family and other real estate investors. The other wheel that you're trying to turn at the same time is you're trying to find deals. And then for like myself, I was working full time trying to do both things, and it was hard, really hard, until I found someone who had good deals and I could leverage them, and we sort of all pulled our money together and we closed on this massive deal. So you need to be developing investor pool before you go under contract on a property. So what I mean by an investor pool, you need to be telling as many people as you can about your deal, so about what you're trying to do. And we'll get into how you do that a little bit later on. But just you want to be developing as much interest in what you're trying to do as possible. You need to be creating a list of investors that you can go to once you've found a cracking deal. So they might have said to you, Reed, I'm looking for a 12% return on my money. Well, I know that Bill is looking for 12% on return on his money. Well, I've underwritten this deal. I think we're going to get an ROI or an IRR of 15%. This meets Bill's expectations. Let's call up Bill. You needed to be developing a pitch book, and this goes back to, so developing a pitch book probably should go first, but developing a pitch book is very, very important when raising capital. It sort of tells a story of what you're trying to do, and you might have a fictitious deal in that pitch book, but you're still getting that pitch book in front of as many investors as you can, friends, family, anyone that they might know who might be interested in getting a good return on their money or renting out and getting involved in real estate. And that pitch book will sort of step them through the processes of how you're going to buy these deals, how you're going to run the deal, how you're going to force the appreciation, and how everyone makes money. Another thing is you don't negotiate enough time. And there's always this chicken and the egg scenario of when you're buying deals and you first start syndicating is, well, I don't have my guys committed on committed capital yet. It's not sitting in the bank. I can't go and find a deal. Well, you can, and I've had a lot of people say to me, I'll read, and I still get this, guys, I'm trying to raise money for this particular type of deal. And they said, that's fantastic. Do you have a deal yet? It's like, no, I don't. And they're always like, come back to me when you do. So, negotiating enough time on your contract to close and raise capital. You might say, well, maybe I should negotiate, 60 days or 90 days on the closing, because that will then allow me to go to all my investors and that I've sort of sent my pitch book to and got them excited and tell them I got a deal under contract, and they can then go through the process of getting the money into the partnership, into the entity, and buying the deal. So negotiating enough time on the contract to close. Deal number 4 is lack of investment strategy. And this, your investment strategy should be clearly defined in your pitch book. And what I mean by that is having no plan. My plan at RSM Property Group, my investment strategy is that we buy value add multifamily deals. I look for repositioning deals. What I mean by repositioning is that I want to be buying a property that I know that is currently rented under market value. I want to be buying a property that I can see I can improve the operational efficiencies on the property. Maybe it's I can bill back the utilities to the tenants. So I'm reducing my operating expenses, but increasing the net operating income. I might put in a new do up all the apartments, and I can raise rents by $60 a month because currently it's under market value. And that is what I look to do to force the appreciation. And that's my plan. That's my investment strategy. And be really specific. Our investment strategy also is Class C plus and B properties. We don't look for Class A. We look in tier 2 cities, which means we look in the Houstons, we look in the Texas, the Oklahoma cities. We look in the Richmond, Virginia. Sorry. We look in the North Carolinas. We look in Kansas City, Missouri, St. Louis. We don't look in LA, San Francisco, New York, Portland. We don't look in that. We look in those particular tier 2 cities for Class B and C properties. We get a higher cap rate, and we look for people who don't ever want to own a property. Our renters don't ever want to own a property again. They've been burnt. They're happy to pay money, for a clean, safe, affordable cost living. And our properties typically have a pool and they have a gym, and they're built back in the late 80s, early 90s. And that's we're specific with our plan. We're not trying to get the lawyers renting from us, or the engineers, or high paid white collar people. We're sort of looking at the teachers, the police officers, the firefighters, the factory workers, guys like that who just want a clean, safe place to live in, and they can bring up their family. So this slide was a little bit. It's supposed to be what are the legal requirements, but I changed it a little bit to. Oh, sorry, I went into a little bit. So, what are the legal requirements of syndication? And well, when you're raising, take a step back. When you're raising capital from the public, the government views it as a public offering, right? And a public offering is very, very expensive. There's registrations. You need to register with the Securities and Exchange Commission, or the SEC. is required if you are raising money from the public. However, it's very expensive to go public with a company. And so there's a lot of small companies out there who still need money for their business, as we talked about before, and they still need to raise capital, right? So the SEC or the government developed this thing called Regulation D, D for dog. And what that is it's in a bunch of exemptions. And Regulation D contains these exemptions from registering with the SEC. Now, and so that means I don't have to pay a ton of money to register with the SEC and then go public. And go public meaning a number of things, right? So what are the requirements that you must meet? Well, you must file a Form D in the state in which you invest in. And this, at the time of this recording, there are changes to this constantly. This is not legal advice. Please consult a security exchange lawyer, and you will need to do that as a syndicator when raising private capital. So so taking one step back is that the Regulation D is a private placement offering, so to speak. It's not public. So that's what Regulation D is. And so you must file a Form D in the state which the investment is in. You must meet the exemptions stated in Rules 504 in either Rule 504, 505, or 506. A common rule is 505. I've seen a lot of this done, and I've done it before. Securities can be sold. What a security means is that investors they give you money, and in return they get a return on their money or a security, an equity, a portion in the deal. So securities may be sold. These securities, the equity may be sold for exchange of investment money. That's what that is. You're selling securities, equity in a deal, and an investor will pay you money for that. That's what it means by being sold. You can sell securities to an unlimited number of accredited investors and up to 35 non-accredited investors. Now, what does accredited investors mean? It means that you earn $200,000 or more a year, or you have a net worth of more than $1 million, excluding your primary residence. That is what accreditation means. The 35 non-accredited investors, you have to prove that you have a prior existing knowledge of these non-accredited investors, and they have to show a form of sophistication in terms of understanding real estate. Now, this solicitation and TV, things are changing in the Jobs Act, so don't quote me on this. I don't, this is no solicitation. I think this has changed, but you can't just solicit to anyone. It's always good to come from the point of view of you're raising capital from people that you know. And if someone is writing you a check as soon as they meet you, then run the other way. Don't be raising, any sort of raising. Anyone with 2 brain cells knows that you need to be forming a relationship, and raising capital just doesn't happen. It's through formed relationships. And if you can prove that formed relationship, you are safe. You have an existing relationship. And this is what this common knowledge of real estate investing is all about. And they need to develop understand the risks involved with real estate investing, and that's what you need to prove sometimes to the SEC if it ever got to that point. But we won't get to that point. So really, just keep in mind that please contact you Google Regulation D. It's very easy to Google. There's a lot of stuff out there. I'm going to have a webinar in a couple of weeks' time just purely on the Regulation D stuff. I understand what you can and can't do, but raising money typically from friends and family, people you've got existing relationships with, it's easier to prove because you've got existing relationships with them. They can be non-accredited. You can have up to 35 non-accredited investors. So that is that. You must complete a private placement memorandum or a PPM, and we'll get into what a PPM is in the next slide. Remember, I'm not a lawyer. Please go and consult your lawyers and stuff like that. Big disclaimer. I'm just giving you some general information about syndication. What is a private placement memorandum? It is a PPM. It meets the requirements of Regulation D, and it gives full disclosure to all the investors involved relating to the offering. So it is a thick document that you'll get a lawyer to write up for you. It costs a fair bit of money. It costs about 10 grand. and you should factor that into your underwriting or your analysis when you are looking at a deal. And if you're raising money, it's just a line item. You have to do it. Please do it. It is always get a private placement memorandum. There's a lot of lawyers out there that do them. And it gives full disclosure to all your investors out there. It's a documentation saying, you want to get involved in this real estate deal as an investor? Sure, here, read this. This will cover literally the A to Z of what could go wrong. And essentially they sign and say, I understand that these are the risks involved. So it's called a private placement memorandum. It's a documentation that contains disclosures. Reg D PPM outlines everything for the company. It also outlines everything of the perspective about the company for the prospective investors, how the offering will be set up, how it will be taxed, outlining the associated risks and how involved with the particular offering. At the end of the day, as I said, consult your real estate attorney regarding an individual deal. Consult your security exchange. If you're an investor, always on your team, you should always have a real estate attorney who is knowledgeable in security exchange law and who can pull together PPMs. Contact me if you're wanting to get involved. I know a couple of lawyers out there who are very, very good and charge reasonable prices. This is the last sort of bit. How do you raise money from investors? And we talked a little bit about this before. Number one, I like to say is professionalism. Not all of us we don't know. You're not just born and you're a real estate investor. Everyone has got a journey. Everyone has a past education, past career before you get involved in real estate investing. My vehicle to creating long-term wealth is real estate. I could have chosen a couple of other things, but I love real estate because I know that industry very well. I'm an engineer. I know how to build things. Being involved in construction, I know real estate. It makes sense. It's historically one of the best performing assets out there compared to the stock exchange, compared to other things. So be professional. At the end of the day, people are going to invest in you because they're going to invest in you. They're not going to invest in your business. And being professional is very, very important. You are a business. Reed Goossens is a business. I'm a business. And as I said, people will look at my professionalism. They'll look at my track record. Coming from structural engineering and being in that corporate world, I brought a level of professionalism to raising capital, and people like that. Being on, organizing meetings, organizing investor meetings, sending follow-up emails, keeping in good communication with all your investors. That is being professional. You need to develop a pitch, and this goes back to my pitch book and a pitch deck, pitch book, whatever you want to call it. And what it is literally an example deal. And you literally pull it from anywhere. You can pull it from loopnet.com. And please email me. Sorry, get off track. Please email me after this show if you want to get a rough template for a pitch book. I don't mind giving mine out. It's pretty straightforward. You can change however you want the colors and of the color scheme and the logo, and change the deal if you want. But it can show you sort of the format. And what it is, it's an example deal, and it's an example scenario of what the purchase price is, how much you're going to raise from investors, the type of returns. And you can sort of, you can change the purchase price to make it look whatever you want, the returns however you want it to look. But you have a big thing. It's an example deal. This is how this deal will be put together. I'm going to put in my pitch book. I'm going to show my friends and family and investors, potential investors, and it's going to go through, structuring of the deal. It's going to go through certain, if you want to get into the fees and how people get paid, you definitely want to talk about the preferred return and the equity split in a pitch book. And it just sort of is a step-by-step guide of how you're going to create long-term wealth with these people's money. You want to be telling as many people as you can, and you want to get to a point where you can give a 30-second elevator pitch. And that's another webinar we can talk about developing your pitch. You need to be hosting investor meetings. So once you develop your pitch book, you're starting to tell everyone, you're starting to email people, you'll be saying to them, hey, I haven't spoken to you in a couple of years. Guess what I'm up to? I'm now syndicating. What does syndicating mean? Oh, well, I'm buying, in my case, I'm buying multifamily properties. Oh, really? Wow, that's incredible. Yeah, investors get involved with me, and they get typically a return of 13% on their money annually. Plus they get all the upside of depreciation and the associated benefits of real estate. Oh, really? That's incredible. And they're the sort of type of conversations you have initially, right? Once you've had that conversation, you'll then follow up with a pitch book. once they've read that pitch book, they might say, hey, I'm interested. And if they say they're interested, you want to be hosting a little investor meeting. And that's a sort of face-to-face meeting that you can walk through the pitch book and answer any of their questions and concerns. And you always want to be leaving that particular meeting knowing that you're going to be following up. Again, all this how do you raise money is going to be a complete another webinar that I'll do in a couple of weeks' time. The last thing I want to talk about is patience. It doesn't happen overnight. You have to network, and you have to increase your network. It's a numbers game. When I say numbers game, the more people you meet, the bigger your network, the more people are likely going to invest in your deal. And it's not going to happen overnight. This is going to take, goes back to developing credibility and professionalism, and your pitch book is building that credibility because you're showing that particular person or investor that you know what you're talking about. It goes back to being professional. There's that one-on-one face-to-face. That takes time to develop. That your story that you're investing in multifamily and you're syndicating, or you're investing in whatever it might be, and you're syndicating, you're using syndication to grow your real estate business. That takes time to tell a lot of people. And when I say it's a numbers game, the more people you tell, the more people are going to know about it. So as I said, it takes time. And my last quote is, the bigger your network is, the bigger your reach, the more money you can raise and the more deals you can get done. So if you're reaching out to 100 people and 5 of them say, Reed, I want to meet and talk more about this in investment opportunity, that's a good number. Don't think that everyone you're going to talk to is going to be, I want to get involved. They might get sick of you, but keep them on. They might be not ready right now, but in 12 months' time, they might be ready. And so it's very, very important with the patience. Keep on top of following up every 3 months or something with potential investors, because as I said, it takes time. People need to develop credibility. You need to develop credibility as you're starting out with raising capital, and get to as many networking events as possible. You're going to be networking like crazy. And if you're working full time, this is what I did. Network. You'll be going to work. You wake up in the morning, you'll underwrite some deals, you go to work. In lunchtime, you'll talk to brokers or try and raise some capital or talk to investors. You'll go back to work. You'll leave work. You'll go home. You'll go to a networking event. You'll talk to more investors. You'll come home. You'll sleep. And that's just the way it is. It doesn't just happen. And building a brand, building your business, building professionalism, building credibility doesn't just happen overnight. So, it takes work, and it takes time. I think that is, sorry. Any questions? You can please check out my podcast. It's called Investing in the US, an Aussie's Guide to US Real Estate. We're on SoundCloud, we're on iTunes, we're also on Stitch Radio. That's my cell. You can see it there, 323-519-1111, or hit me up at reed@rsmpropertygroup.com. That's my personal email. I'm all too happy to talk about how to get involved in syndication and how to do more to grow your real estate business. And I just love talking about real estate in general. And my podcast is about investing in the US and how the pitfalls that I found as an international investor, but it's not just international investors who have these pitfalls, it's anyone who's getting involved in real estate in the United States. So tune in and hopefully you get some value out of it. Quickly, just want to end up with the Woodglen deal that we did in Texas last year. So the purchase price was $14 million. $14.1 million. It's a 250 unit deal, and it's a Class B asset, B for Bravo. It was built in 2000, and obviously the strategy here was a value add strategy. We raised over $3.3 million in private equity, and I say I raised a portion of that. My 3 other partners raised a portion of that. This particular deal came to me through my networking event that I host in downtown LA, if some of you have been there. And it would go back to pulling those 2 wheels. One wheel is investors, one wheel is deals. One of the guys at that networking event had this deal, was starting to actively look for deals, and he was very good at finding deals. I had access to a little bit of capital through my small network and my mentor. And I was and that was leveraging other people's abilities, and we will all be able to come together and close on this massive deal. And I, going into this, commercial multifamily real estate, I had no idea that I was going to raise, we were going to raise that much money and buy a 250 unit deal. I thought I was going to buy a 20 unit deal. So I went all against what I said before about don't buy too big a deal. But Still take that advice. And it was a 20% down payment. The financing on it was 80% loan to cost, including the construction loan. We had a rehab budget of $4,500 per apartment. Now, remembering this was built back in 2000, so it need $4,500. Think about that. New countertops, new light fixtures, new tiling, new flooring, new paint. $4,500 goes pretty quickly. We were able to increase. This is what we thought we were able to increase it by. We've owned this property for now going on 6 months. We thought when we underwrote it for $60 to $75 a month. Now that's over 250 units, so that's really increasing the value. The NOI of that property significantly. But actually, we're getting higher than that, which is really, really incredible. Like it's averaging around $85, $90 a unit once we've done the rehab. So very, very awesome. We have multiple exit strategies in terms of once we've done the repositioning. We can refi the property, cash out some investors. We have an opportunity to sell the property at the end of 3 years, or sell the property at the end of 5 years. So this is the analysis that we did. This is a very high level analysis. The property currently, as is, the total income per month was $188,900. That's an annual of 2.2326-ish. We had expenses of 106, and we had the NOI was just shy of $1 million a year. With the cap rate when we purchased it is 7.05%. The power of increasing NOI, and this will be, as I said, there'll be a whole nother episode on this. So the value add program, and we predicted, I said $70 to $85 a month. Sorry, this slide is wrong. It should be $60 to $75 a month that we were projecting. So the unit renovations, and we improved the landscaping. We spent $4,500 on upgrades, and we're projecting to complete that over a 12-month period. And we're going to put $500,000 towards exterior upgrades. And the biggest thing we put in is new property management. And one of the great things about this particular deal is the property manager was based out of Utah, and this is in Houston, and it was just ridiculous that he was trying to run it from from Utah. We got a local guy, my business partner. He formed a relationship with a local property management company. Not a huge one, just a smallish one. They chipped in like $250,000 to the down payment. They were part of the general partnership, but they also got the upside of the property management fee that you pay out of your income. And so they're now invested in the deal, and they've got skin in the game. It's just a really, really smart business decision. And it goes back to mitigating one of those risks. Was what if the property manager doesn't do their job? Well, they're now financially involved in the deal. They wanted to be doing their job. So that was just an example. I went off topic there a little bit, but anyway, we renovated the units to so we could match the market rents. That was sort of our value add. So the value add, once if we go back one, so the $188,000 a month, we increased it to $220,000. That was an increase of 16.5%. The expenses, just for this particular example, I kept the expenses the same, but we are looking to optimize the expenses. So we were able to increase the NOI. The NOI was 994, and we 1.3, so it's 38%. And we just set a market cap rate of 7.5%. New property value is now $18 million, $18.3 million, and that's a 17.5% increase in value once you get that stabilized and increase the rents. So that's the power of increasing NOI. And as I said, it's a whole nother webinar that I will do. So this is just the summary. Year one, it's going to take us, we're going to have this is going to be NOI at the end of year one, because we've got to renovate the apartments. You can't click your fingers and rents are increased. It takes time to renovate apartments and get new tenants in. We stabilized it at 1.3. We're thinking we're going to be able to get a 2 to 3% increase in rent between year 2 and year 3. The cap rate in the market's 7.5% in that particular area. The new value is going to be the new NOI, which is $18.3 million. So in 3 years, we were able to increase the value of the property by $2.7 million. That's excluding, this is going back to what we're talking about, that's excluding the cash flow we get from the property. The property's cash flowing all this time. And so this is just the forced appreciation in the equity, and that's what I talk about, equity and the profits. Back when in one of those other slides about how you make money, well, this is the profit if you sold it after 3 years. This is a projected profit, and this is how what I love about multifamily deals is that the banks value cash flow. Again, another webinar we'll get into in a couple of weeks' time. So that's everything. I hope you guys got an absolute lot out of today's show. And we will do it all again next time. And I really please reach out to me at any time. You've got my information. You've got my personal phone number. Check me out on iTunes and Facebook. Also with my meetup event in downtown LA, it's called LA Real Estate and Crowdfunding Club on April 6th at the WeWork office spaces in downtown LA. We will be doing just a networking event. It's called a wine down, and that means just bring a bottle of wine, and we're going to talk about real estate and network with a bunch of people and businesses and startups and have a great time. Have a bit of cheese, and yeah. So hopefully you can all join me there, and hope you got a lot out of today's show. And we'll do it all again in a couple of weeks' time. I'll go, if you've got any topics that you want me to cover, please email me. But I will be sort of delving more into. We've understood the high-level syndication. I'm going to delve into more about value add and how to, we'll talk a little bit more about how to identify operational efficiencies in the NOI and understanding how to underwrite deals better. So thanks a lot, guys, for all of you who stopped by, checked out, and we'll talk again soon.